Hey everyone! Looks like some people are getting popped in here while everyone's connecting. Just wanted to say thanks for joining the call here, and oh, got some activity here. Okay, cool. Yeah, everyone's coming in. Yeah, thanks for joining. My name's Kyle Bogie. I'm with Nth Degree CPAs. I'm the tax director here. Also on the call here from our team is Zach Trahan.
Everybody.
He is kind of our client onboarding specialist. He helps everyone get where they need to go within our firm, and he helps with a lot of the kind of introductory questions that we get here. So while everyone's getting connected here, we'll just kind of hang tight for a minute. This video session is going to be recorded so that anyone who couldn't make it into the call can get access to the information that we talk about here. If you're familiar with Zoom, there's a little chat feature here at the bottom. While we're going through some of the content here, feel free to drop your questions in there. After we get through kind of some background on real estate professional status, Zach's going to start kind of keying up some of the questions you send our way, and then we will we'll get those answered for you as best we can. Okay, so it looks like
Cal, if you don't mind, just in case people are new to Zoom, the presenter view is the option you want to be in, just so you can see Kyle instead of a bunch of dark boxes, just in case anybody's new to the platform.
Thanks, Zach. That's helpful. Yeah. Okay, cool. So, we've got a good team going here. So we'll go ahead and get started. Just a little bit of background on me and our firm. I could tell you the stereotypical stuff you hear from every accountant, that we work with business owners. We're really good at being proactive and providing planning and all that. I don't want to bore you with those level of details. I will tell you that I got my start in accounting as a CPA. Working with a firm that kind of specialized in working with large corporations and kind of the individuals that were stockholders in those corporations. And the thing I found was the work was very compliance based. It was really just cranking out tax returns once a year and not really having a lot of impact in kind of the day-to-day with those clients. And the thing that I really found upsetting was even when we did find opportunities to help our clients save money or, make them aware of some really cool tax savings opportunities, oftentimes they choose to pass on those because it was much more comfortable for them to continue to do what they knew rather than to try to learn something they kind of anticipated would be some complex tax thing. So as a very young CPA, it was kind of tough being stuck in that position. Luckily, I ended up getting connected with Nth Degree CPAs, particularly our CEO, Dan Nicholson, whose philosophy is really around kind of taking complex concepts and then making them digestible for the people that could actually use them. I thought that was really exciting. I joined up the team here at Nth Degree, and we really do kind of try to put that into practice. So our philosophy is really around making things digestible so that people can use tax and accounting concepts and strategies to achieve, their larger personal and professional goals and priorities. It sounds great to save $10,000 on tax, but unless that actually aligns with some sort of objective that you have at a personal level, it may not be worth your time to kind of pursue that savings. And so that's what we really do, is try to align those two things, make sure that anything we tell you to do or advise you on, one, you understand, and two, it aligns with what you're trying to do personally. And so, you might have a financial goal that's around retiring early, or it may be as simple as, hey, I need 10 hours back out of my week so that I can do some of these things that I want to do. And so there's different ways to achieve those goals. We need to put a dollar number behind them and then find a way to make those happen. And so that's really what we do here at Nth Degree. For this presentation, we're going to kind of walk through some of the background on real estate professional status and then jump into some of the questions that you all have there. So I'm going to go ahead and share the screen. Right. Zach, are you able to see that there?
Yep, we got you.
Cool. Okay. So yeah, let's jump in here. What is real estate professional status? Well, I think to tell you the benefits of real estate professional, we need to talk about real estate from a tax perspective in general. So rental income, rental losses are considered passive income by the IRS. The IRS differentiates between active income and passive income by looking at the degree of involvement that an individual has in the activity. And so a normal job, a W-2 job, or somebody that has owns their own business, that's considered active income because you're actively providing services to this business. Whereas a rental is more passive in nature. You sort of set the stage and the activity sort of generates its income on its own. Because there's kind of a difference in those types of activities, the IRS says that losses from a passive activity cannot be used to offset income that you're getting from an active trader business. That's where reps or real estate professional status comes in, is if you are actively involved enough in real estate, then you can make the argument that this is an active trader business for you, which frees you up to use potential losses that you have from real estate activities to offset active income that you have from other sources. So the way that people will generally use this is they'll have a pretty lucrative W-2 job or business that they own, and they're able to generate losses from real estate. And we'll go into some of the ways that you can kind of supersize your real estate losses, but generate these losses, and then you can use those losses to offset your other income and recognize some pretty significant tax savings. Yeah. To claim real estate professional status and actually receive the benefits from it, there's sort of a two-factor test that you need to meet. First is the real estate professional test, meaning more than 50% of your work needs to be in a real estate trader business. So work, it would be services that you provide. So W-2 job, small business, contract work, everything gets grouped all together. If more than 50% of your time is in a real estate trader business, you can make the argument that you're a real estate professional. This is a test that's done at the individual basis. So if there's a husband and wife that own rental properties, for the real estate professional test, we're looking at the activities of a single individual. The second test is our material participation test. This test looks at the activities of the couple and the activities that are associated with each individual property or group of properties. And we'll talk later about grouping properties, but we look at how much time you've contributed to each individual property during the year. And you have to meet one of a series of tests in order to make the argument that you materially participate in that activity. The tests that most people hit here are more than 500 hours, more than 100 hours, and more services than any other individual is providing to that activity. The last one, which is really hard to hit, is substantially all the work performed by you. This basically means you're doing all the upkeep, you're managing the property, you don't have really any service providers that are providing services to your rental. So if you can achieve both of those tests, great. Now you've claimed that you're a real estate professional and you can use losses that you recognize on your properties to offset other income. One of the biggest things that you have to do when you're a real estate professional is track your time. This is because if you were to be audited and the IRS wanted to argue that you were not a real estate professional, you need to be able to hand over documentation that shows that you've met those hours tests. And so best practice is to maintain a log of your time showing the dates that you worked, the times that you were working, and the specific activities that you were doing during those times, because you need to be able to make that argument to the IRS and stand behind it. There's an app that a lot of people will use called Clockify. It's a free time tracking app that allows you to kind of maintain a good log of everything that you've done. So I definitely recommend going after that if you're going to try to achieve that real estate professional status. We often get a lot of questions around qualifying activities. You know, what qualifies for our 750-hour test for material participation tests? Pretty broad in the way of real estate activities. So we can look at anything in the way of development, construction, acquisition, rental, operations, management, leasing, brokerage, really anything that's directly or kind of ancillarily connected to real estate. We often get questions around commuting time, so traveling from your home to the various properties that you own, can you include that time? The default is no, but if you establish an administrative home office, which is basically a home office where you are overseeing and running the background administrative duties of your rental activities, then that's your primary location of business. Any commuting you do between there and the properties that you own then becomes qualified travel time. So a little note there that you can put in your pocket. There's also a lot of questions around time spent researching potential properties. This is an area of a lot of contention, and the IRS and the tax courts have often found against taxpayers trying to include that time in their calculations. So can you include it? There's nothing that says you necessarily can't, but the IRS has found, has won arguments against that pretty regularly. So we would say that's poor evidence or poor time when we want to generally include the best types of time, which is time spent directly working or managing the properties that you own. Yeah, we talked a little bit about this before. Grouping activities. So if you own multiple properties, you can make an election on your tax return. And this election is can be done annually, but generally you'll make the election again each time you add a property. That allows you to take each individual property that you own and treat them as a single grouped activity for purposes of determining your material participation hours. So an example would be if you had a single property and you didn't meet that 500 hours test, but across 3 or 4 properties that you own, you definitely hit that 500 hours. You can make the election to group those properties, and then you add up all the time you spent across the different properties. It makes it a lot easier to hit that hours test. Yeah, so that's kind of the background on real estate professional status in general. You know, what if you don't qualify? So you don't hit the test in terms of hours. You still have interest in investing in real estate. You know, still, it's not a terrible idea. You know, what we said, passive losses won't be able to offset active income. That's fine. In this case, your passive losses aren't gone though. They'll carry forward, and then you can use them in future years to offset passive income that you may have. They also free up in the event that you sell the property that the losses are associated with. So if you've accumulated $10,000, $20,000, $30,000 of passive losses over a few years, and then you sell that rental property, in that year, those losses free up and can be used to offset ordinary income. Similarly, if you have multiple properties and you sell a single property for a gain, to the extent that you have gain from that property, that'll free up an equivalent amount of passive losses from other properties. And so there's still some good benefit there. The other thing that's nice is rental properties generally are cash flow positive, meaning you're getting, in terms of rental income, more than you're paying out in operating expenses. But from a tax perspective, they often recognize a loss, and that's because of something called depreciation, which is basically your ability to recognize the purchase price of the property over its useful life. So a residential property, the IRS says has a useful life of 27 and a half years, commercial properties 39 years. Back of the napkin math on that, you take the purchase price, let's say it's 500,000, divide that by 27 and a half, and you're able to take that amount as a deduction each year as depreciation against the property. So it allows you to kind of maximize your deductions for something you're not actually putting cash out for, which is really nice. We often get questions around short-term rentals as well. The IRS has some funky rules around short-term rentals. Basically, if your average rental is less than 7 days and you're providing services that are kind of beyond what's normally offered in a standard rental relationship, the IRS says that's no longer a passive or a rental activity and is more of a hotel-style active business. Not to get too in the weeds on the tax side of things, but that would move the rental activity from being reported on Schedule E, which is where rentals are generally reported on your tax return, move that over to Schedule C, which is where sole proprietorships or small business income is generally reported. Your profits, if you have them from this property, then become subject to self-employment tax. Self-employment tax is your FICA, your Social Security and Medicare taxes. As an employee, you pay 50% of your employment taxes. Your employer pays the other 50%. If you're self-employed, you pay both sides. So that can be as high as 15.3%, though after you've earned about $130,000 in income, you're no longer subject to the Social Security taxes. So then you just pay a 2.9% Medicare tax on everything in excess of that. So what we often see is that people hit that cap through their W-2 salary, and then they're just paying that 2.9% self-employment tax on any income that they have from the short-term rental. The short-term rental, though, does still qualify for depreciation. So you're still able to kind of push through some extra deductions and hopefully put this into a tax loss. If you have material participation in your short-term rental, so similar tests, similar hours thresholds that we're looking at there, if you're able to achieve that with a short-term rental, you can actually use the losses from a short-term rental to offset ordinary income. So people that are unable to meet that REPS test can still recognize some of those benefits by getting involved with short-term rentals. One note on the short-term rental is if your short-term rental is reportable on Schedule C, your time spent in that activity doesn't qualify for the REPS calculations. So the 750-hour overall test or the material participation test. So just a little note there. Yeah, just wanted to make sure everyone kind of had some background on that stuff. Now I want to make sure we have plenty of time for questions. So Zach, do you have we got any questions coming in through the chat there yet?
None in the chat yet. So everybody, if you want to just message either to myself, Zach, or everyone in the chat, I can feed the questions to Kyle to be answered. But oh, we've got a question. So it says commercial property rented to businesses into the REPS hours. I'm assuming that means do the commercial property rented, does that count for REPS hours?
Yeah, thanks, Zach. Yeah, great question. So if you own a commercial property and you rent it to your business or to another business, your time spent specifically on duties related to that, to managing the rental side of things will qualify here.
And then we got explain passive losses in detail, please, both for residential and commercial properties.
Yeah, good question. So passive losses, anything that's considered a passive activity, which is generally going to be rental activities. But if you're involved or invested in other types of investment partnerships that you're not actively involved in, the ordinary losses or income from those activities would also be considered passive activity. It's basically going to be businesses that you're not actively involved in. are going to be considered passive. Those losses that you might incur from a passive activity, they carry forward. So if you had $10,000 in losses this year and you didn't have any passive income that you could use to offset with those losses, they'll carry forward to a future year. And if you're able to get some passive income in that future year, you'll free those up and you can use them to offset income. Cool. If I didn't answer your question there, let me know and we can drill down on that a bit more.
Cool. And then make sure I'm on the right. So would any hours associated with the house hacking / renting out part of primary residence count towards reps?
So if you're renting out your primary residence, is that basically what the question is getting at?
I believe so, yeah.
Okay. It's a good question. If it's still going to come down to that material participation test. And so if you can show that you've materially participated in the rental of the space in your home, you can include that time in that calculation.
Cool. And then how about if you purchase property that has a NNN lease, a triple N lease?
Yeah, good question. Let me see here. Triple net lease. Can you read that question for me one more time, Zach?
Yeah, so it says, how about if you purchase property that has an NNN lease? And this is from Vane. Let me take a look what her first question was. And I believe that the original was, would a lease like that?
Commercial?
Yeah, with that. Yeah, exactly. Mm-hmm.
Got it. Okay. Yeah, good question. So you'll still be able to qualify there. You own that property. It may impact your ability to recognize some of those depreciation deductions. It just depends on what your basis in that property is going to be.
Cool. And then we got a question here. It's if you own a rental property with someone else as joint tenants with survivorship, then in parentheses, not your spouse, and you are only one meeting reps, can you allocate all of the losses or substantially all of the losses, such as 99%, to the person with reps?
Yeah, that's a great question. So that's kind of a funny relationship, the joint tenants with the right of survivorship on a rental. Basically, from the IRS's perspective, both individuals have rights to that property and the right to rent it out. And so what we've seen before is that one individual is involved in actively renting out that property. The other person is not really involved in the rental activity. So in that case, yes, you can assign all the losses or all the rental activity to the individual that is, quote unquote, doing the rental. It doesn't have to be split with both individuals.
Awesome. And then we got a question. My understanding is that 500 hours have to be material participation and the other 250 can be other things. And then the question is, can educational activities be included in the 250?
Yeah, that's a great question. So yeah, you kind of do the math there and you go 750, but only 500 need to be material. What's the other 250? It just has to be something that's in line with a real estate trader business. And one area of activity that's ordinary and necessary in the course of business is continuing education. And so time spent learning more about this business that you're involved in definitely does qualify for meeting that other 250 hours.
Cool. And then we have, so if you have both long-term rentals and short-term rentals, in order to claim losses towards W-2 income, you'd have to have 500 material hours on long-term rentals as a group and other 500 material hours on the short-term rentals, question mark?
Yeah, good question. So yes and no. Remember that 500 hours is just one of the material hours tests. The other test that we could look to is that 100 hours test. So What we'll see usually here is if you've got a split, you've got some long-term and some short-term, people are achieving that 500 hours test for their long-term rentals. And then for the short terms, they're hitting the 100 hours test, but still providing more services for that property than any other individual person is. And so if you're managing your short-term rental or your spouse is managing the short-term rental, and you're not outsourcing a lot of the upkeep and work on that property, that's how you'd achieve that when you're combining long and short-term.
Awesome. And then we had another question about education hours, and I think we answered that. So if we didn't, or if you need some more clarification, just ask the clarifying question, we'll hit it again. But we got a question, can you talk about NOL carryback and other CARES Act considerations?
Yeah, definitely. So the CARES Act has come into play recently and it's opened the door for the ability to carry back net operating losses to previous tax years. What does that mean? It means if you're able to recognize a huge business loss this year, you can carry that loss back to previous years, previous tax years that you had income, and you can amend those filings to claim the net operating losses that you recognized this year against income from a prior year, and you can get refunds of taxes that you paid previously. Sounds really nice, and it might be. There is some coordination that you need to do between where you're going to see the most benefit. It may be more beneficial for you to recognize losses kind of spread out over this and future years rather than carrying them all the way back. And that just depends on the value of your other deductions. And so if you carry back a loss and you offset your income, you move yourself down into a lower tax bracket, your deductions from those earlier periods are worth less because they're being taxed, you're being taxed at a lower rate. Whereas if you carried some deductions over to next year to offset some of your income, assuming you're in a higher tax bracket, that loss may be worth more in a future year than it would be in a carryback year. I say all that to say, that's why it's really, really important to have kind of ongoing service and planning, access to a professional, to a CPA that can help you with that level of planning. With regards to reps and really any more complex tax strategies, there's not really a kind of set it and forget it plan that you can do. You really do need to kind of have regular and ongoing access to support. Our clients, even those that are kind of taking advantage of the most in the way of, sorry, just letting a couple more people in here. Taking advantage of the most tax savings opportunities and really getting involved with some cool strategies. They're checking in with us regularly, and we're able to kind of redirect and course correct to make sure that they're not missing out on any opportunities.
Cool. And then we got, what do you think is the best way for outside of state investors to achieve reps or have maximum tax write-off? So I believe that's you're investing in real estate outside of your state, and what's the best way to get those hours? And Billy, if I'm interpreting that wrong, just post a clarifying question and we'll get to it.
Yeah, no, that's a great question, Zach. It's a question we often get. It kind of aligns with, if we use a property manager, are we not going to be able to qualify for reps? That's where that grouping comes in. So having more properties and grouping those usually allows you to get closer to that material participation test. But it is a test. So you have to kind of get creative with ways that you're going to be involved in this property and show that you're putting in the time. So if you're out of state, obviously, popping by to do general upkeep or, checking in with tenants and stuff may be more difficult to do. So that's where you need to start spreading your time across multiple properties. So if you're able to hit fewer hours, but you have more individual properties that you need to keep up with, those hours are going to start to stack up. The other question there is around maximizing your tax write-off. We may get into this in some of these questions here, but if not, there's something called a cost segregation study that we highly recommend in the year that you purchase a property. What that does is allows you to kind of supersize your depreciation deduction in those earlier years. Cost segregation is what it says. It takes the cost of purchasing your property and it divides it or buckets it out into individual assets that make up that building. So if you buy a building and it's depreciable over 27 and a half years, and then you chunk it out and you say, okay, well, really there's these fixtures over here and there's this lighting and carpeting and the roof is this piece and the walls are this, and you kind of break it up into these different individual components. Some of those components from a tax perspective have a shorter useful life. And so if you're able to get as much of that cost into shorter useful lives as possible, you'll be able to recognize those costs a lot faster. Some properties, 5, 7, 15-year property. Additionally, right now, the tax code allows for something called 100% bonus depreciation. What that does is allows you to recognize 5, 7, 15-year property costs all at once in the year that you purchase them. So let's say you buy $1 million house and you're able to push through 20% of that as an immediate bonus depreciation through a cost segregation study. You've now just freed up $200,000 of write-offs that you can use in that first year. And so we'll see people that do kind of new acquisitions, cost segregation studies, and kind of maximum bonus depreciation deductions on a regular basis to recognize some pretty significant savings each year.
Awesome. And then at what age can kids take over our real estate investment property / business legally? And yes, in parentheses, IRS rules. Until then, can limited partnership be created and have them listed? Is this a safe strategy or not? ? What's the best way to do this?
Good question. So it's going to come back to kind of your overall intent there. Some people intend to have their children get involved with a property so that they can start to shift some of the income to their child. That because the child overall has a lower income than the owner or the parent, so that that income's taxed at a lower level. Other times, people will look to hire their children as employees. The nice thing about that is if you pay your child under kind of the annual minimum amount required to file a tax return, you can start to put some money into an IRA for that child, and they don't have to file a tax return or pay any tax on that income. So there's a couple different reasons you might look to hire a kid or get them involved. Generally, if you're looking to hire them, they have to be old enough to be able to actually provide real service, whatever that is. So I couldn't hire my 3-year-old to be a property manager. But if I was going to, put together some sort of an advertising campaign, maybe I could hire her to be, a model in some photos or something. As far as giving them ownership or making them an owner in a business so that they receive like a K-1 from a partnership, that can be done generally at any age, but for minor children, their income is either going to be rolled up into the parent's income, or there is some more complex tax implications to that, where the children's income gets taxed at the parent's tax rate. So that is an area that's kind of more complex beyond the scope of what we can really get into here. But if that's something that you're interested in getting more information about, you've got Zach's contact information there. Follow up with him, and we can get you some more guidance around that.
Perfect. And then is managing and renting out self-storage units included in the reps activity?
Oh, that's a good question. My understanding on the self-storage units is that would be an active trader business, but it's going to depend on your level of involvement in that property or that business. I don't have a quick answer on that, but it's a really good question. follow up with us on that, and we can get you an answer on that offline.
And then how would a direct mail campaign and the associated research count toward my rep status or reps hours, provided that it is produced a property acquisition?
Good question. My assumption is this is some sort of a direct mail campaign where you're looking to encourage people to sell you their properties. If that's the case, that is going to fall more under an investor bucket than it is going to fall under a real estate bucket. So my assumption is if you were to be audited there and the IRS started to push back on that, that'd be an area where they'd question your hours. And it's hard to say what the tax court would find on there, but I think they have an argument for kind of classing that under what they consider investor activities. And they'll look to minimize the number of hours that are included for that. That said, it is sort of loosely tied to your real estate. So I'd say first try to go after good hours. And then if you need to pad your time with this in order to meet those tests and you feel confident about your ability to argue this point, that's where you kind of pad it with some of these more gray area hours.
Awesome. Then we have a clarification question from earlier. So say, for example, I have an ADU unit in my primary residence and rent it out. Would this activity / managing this rental count towards reps?
Yeah, good question. So with an ADU or you have an accessory unit, I would absolutely count that towards reps. That's a rental activity very similar to any other residential rental.
Cool. And then I have kind of a double question here. Obviously, a couple people interested in this. So can you talk about borrowing money from your 401k for real estate investment? And then we have an add-on here, but also your take on CARES Act eliminating the penalty for withdrawals from retirement accounts.
As a CPA, I can't get too much into investment strategy or, does it make sense to pull money out of your 401k? But under CARES Act, you're able to pull money out of your retirement account without a penalty right now. And you can use that money for, as you wish, basically. So some people will pull money out of their 401k to use it for investment in real estate or other purposes. I can't really say whether that makes sense as a strategy. It's really going to come down to the individual and your personal goals. Rental as an investment within a 401k. So if you have a more flexible 401k, a self-directed IRA or 401k, you have more flexibility in where that money is invested. So you could invest in real estate. If you do that, just keep in mind that those investments are still held within your retirement account. So they're not, there's less flexibility in the way of, using those funds for other purposes. So if you wanted to sell that property and recognize a gain on that, just keep in mind all the funds are still trapped within your 401k. But not a bad investment strategy if you're confident in kind of real estate and the market.
Awesome. And then Ashley asks if we'll be sending out a recording. We absolutely will send out a recording to everyone on the call, and feel free to forward it to other folks who you think might find this information useful. Then the next question, can you not do a cost seg in subsequent years if you did not do it in the first year?
That's a really good question. So there is an opportunity to do cost segregation studies in years after you've acquired a property. So let's say, you bought a property in 2016 and you're sitting on this webinar now and you realize, oh shoot, I could have done this cost seg thing and recognized a bunch of depreciation back in 2016 and I missed out. Luckily, the IRS's rules around depreciation are pretty complex. One of their rules is that you have to treat depreciation as though you took the correct amount under the law every year. So what that means is if you go back to 2016 and you had done a cost segregation study and you should have taken bonus depreciation, there's a certain amount of depreciation that you should have taken in that year. If you took something less than that, the IRS says, well, we don't really care that you actually claimed less. We're going to treat it as though you took the correct amount. Congress has come back since and basically opened the door for some corrective action there, saying, okay, well, if you're going to require people to act as though they took the right amount of depreciation, we need to let them do that. And so there's an opportunity to file an election with your tax return for the current year that does some kind of retroactive shifting where you can go back, treat it as though you did a cost seg on that property back when you purchased it, figure out what your depreciation deductions should have been in each of the subsequent years, and then push through it. They consider it a change in accounting method, but basically take some corrective action to true up your depreciation and push through the difference in the current year. So long story long there, but basically, yes, you can go after those cost segregation studies even years after you've acquired a property. You do have to wait at least 2 years. So because this is considered a change in accounting method, after you filed a certain way for 2 years, you've established an accounting method. And so that at that point, you can change your accounting method. So if I bought this property and filed my tax return for 2019, and it's now 2020, I can't go back and do that cost seg and push that through yet. I'll need to wait until 2021.
Awesome. And then it looks like we have a follow-up question to that is if you lived in the property for a couple of years and then rented it, can you do the cost seg at that point?
Yeah, you can still do the cost segregation study. The cost segregation experts, the people that will come out and actually do the study for you, my best advice in that area would be to get in touch with somebody and see what they recommend in terms of timing and their involvement. Because this is all they do, they're going to be really good at telling you like, hey, yes, it makes sense for us to come in and do this study, or no, let's wait, or if you did happen to miss your window because it's been so long, they could tell you that as well.
Awesome. And then can you sell your property in an LLC to another LLC you own and claim bonus depreciation again for the same property?
No. So there's look-through rules for LLCs. By default, a single member LLC, so an LLC that only has one owner or a husband and wife owner, is disregarded for IRS purposes. The IRS don't even recognize that as a separate entity from you. And so moving ownership around across LLCs that have the same ownership, it doesn't trigger any new depreciation or freeing up any losses or anything like that. The IRS is ahead of us on that one and has put measures in place to prevent that.
Cool. So the next several questions are kind of similar. So I'll try to frame them as one question here, but I'll hit kind of the differences. So I live in California, thinking about investing in the Midwest. How can I get reps? Should I consider doing short-term rentals in California to get reps? And then just to highlight the next couple questions here. So travel time out of state to acquire properties will not count towards hours, question mark. And then finally, so if you lived in a property if we have a property out of state, 15 hours away, and normally we fly, but due to COVID would drive, does this count towards the hours? So kind of the same theme across those. Yeah,
good question. So out of state, the common question there is, how do I get my material participation? Because I'm not right there. I'm not regularly traveling to the property. If it's out of state, you can still achieve that generally through grouping. So you're looking at kind of combining activities across multiple properties to hopefully reach that threshold. There was a question around travel to properties that were out of state, flying versus driving, that commuting time basically. We touched on this. So in order to to have your commuting or your travel time included there in those calculations, you want to first establish a home office where you're kind of overseeing your real estate activities in a whole. By establishing that as your primary business location, then any travel outside of your primary location to any other location is considered business travel or business time. And so in the scenario where you're driving instead of flying, or even if you are flying, you can count that time towards your material participation there.
Awesome.
And the last question, I think, Zach, you said, should I invest in short-term rentals in California to try and get reps?
Yeah, and that was along with they're thinking about the Midwest as a place to invest.
Gotcha.
Yeah.
Cool. So short-term rentals, in their nature, generally, you're providing some level of housekeeping services, some supplies, or something beyond kind of the normal services that are offered with a longer-term rental. And because of that, the IRS is going to say that rental is not a passive activity, but is instead an active activity and needs to be on Schedule C. When that happens, generally short-term rentals are not counted towards your reps calculations. So going after short-term rentals would not be a good way to try and achieve rep status.
Cool. And we have 2 questions kind of get the same thing here. And basically, how do you set up a home office, or how do you make that official?
How do you set up a home office? Yeah, that's a good question. So the IRS's rules around home offices are you need to have a space that's used exclusively for trade or business. So you want to have a space in your home that's clearly delineated. It's not, combination space. So, if my home office also has, let's say, a bed in it and a TV and some video game system or something, and an IRS auditor came in to look at that space, they've got a pretty good argument that space isn't being used exclusively for business because there's other stuff going on in there. So you really do want to have a space that's kind of clearly defined. It looks like an office. It has the types of equipment or fixtures that you would expect to see in an office space. And then you want to claim the home office deduction on your tax return. So what that is generally a square footage allocation of your home costs to the business. So, if my home is 1,000 square feet and my office is 100 square feet, then I'm taking 10% of my utilities, my mortgage interest, my property taxes, homeowners insurance, all those things, taking 10% of that cost, aggregating it, also depreciation, and including that as a deduction with my rental activities.
Awesome. Nope, we got one more here. Can I do my own rehabbing, flooring, painting, etc.? And would that qualify for reps?
Yeah, that's a great way to do it. So anything you can do DIY, that's your time in construction, development, redevelopment. I think a lot of people choose to outsource that stuff, and that's fine. But if you're able to do it yourself, you can absolutely include that time in your material participation calculation.
Awesome. So that's the questions we have, Kyle. I think you covered a lot of information there. Thank you for doing that. So if there's no other questions, we'll be doing another session like this on the 23rd of this month. So I'll certainly send out that invite list to everyone here, and happy to answer questions in that time also. If you need more kind of one-on-one help or are interested in discussing more, feel free to email me at the address listed there. I think I've spoken to most of the folks on here, so feel free to just shoot me a note and we can figure out something that'll work. But Kyle, anything else to add before we close out?
Yeah, Zach, if I can, I just want to say, I can't stress enough the importance of having kind of an open dialogue with your CPA, an ongoing relationship. There needs to be no barriers for you to pick up the phone or jump in an email and ask a question. because, you know, a lot of the stuff that we went over today, bonus depreciation at 100%, the CARES Act stuff, the tax law is always changing, and there's always new opportunities that are coming in, or old ones that are no longer applicable anymore. And unfortunately, in a lot of client CPA relationships, most of the communication and planning and tax prep is done retroactively. You're really doing it when it's time to file your tax return. And at that point, you've generally missed out on a lot of opportunity. So, you know, our whole thing with our clients is establishing these ongoing service agreements where we are there and we're available and we're checking in throughout the year, so that you're never alone and you're never having to try to figure this stuff out kind of single-handedly. And so yeah, I'd say, you know, if we can, reach out connect with Zach, and let's see what we can get going for you guys.
Awesome. Thanks, everybody.
Thanks, Zach.